The self-made millionaire. This is the most common type and the least understood. The self-made millionaire built their wealth from nothing. No inheritance, no head start, no family safety net. What makes them different is not the money. It is the process. Most self-made millionaires took between 20 and 30 years to get there. They did not win, they compounded. Small business owners, tradespeople, doctors, engineers who invested consistently and spent less than they earned, decade after decade, until the numbers became undeniable. The popular image of self-made wealth is a startup founder ringing a bell on an IPO day. The statistical reality is a 54-year-old plumber who has been maxing out his retirement account since his early 30s. The inherited millionaire. Inherited wealth is older than every other type on this list. These are people who received their money rather than built it. A family business passed down, a property portfolio left behind, a trust fund activated at 25. What separates them is not the amount. It is the relationship to money. Inherited millionaires often have no lived experience of earning the wealth they manage. Some go on to multiply it, others treat it like a salary and slowly spend it down to zero. Studies consistently show that inherited wealth disappears within 3 generations in the majority of cases. The first generation builds it, the second maintains it, the third spends it. This pattern is so reliable that wealth researchers have a name for it. Shirt sleeves to shirt sleeves in 3 generations. The real estate millionaire. Real estate has created more millionaires than any other asset class in history. These are people who bought property, held it, rented it, and repeated the process until the portfolio did the work for them. What defines this type is patience. Real estate wealth is almost never fast. It is built through 10, 20, sometimes 30-year holding periods where land appreciates, mortgages get paid down by tenants, and equity quietly accumulates in the background. Many real estate millionaires started with a single property they could barely afford. The second one was easier. The third easier still. At a certain point, the income from existing properties funds the acquisition of new ones, and the process becomes self-sustaining. The stock market millionaire. These are not day traders. That is the first misconception to clear up. The stock market millionaire typically built their wealth by buying broad index funds, contributing consistently through every market crash and every market boom, and refusing to touch the money for decades. Warren Buffett is the famous example at the extreme end. But the more representative version is the ordinary worker who started investing at 22, never stopped, and woke up at 60 with a portfolio that crossed 7 figures without a single dramatic moment. Research shows that the average 401 KEGS millionaire in the United States took 26 years to get there. No shortcuts, no timing the market, just time in the market. The business owner millionaire. This type built a company, not a startup chasing venture capital. A real business with real customers, real margins, and real cash flow. Plumbing companies, dental practices, logistics firms, regional restaurant chains, insurance agencies. These are the industries that quietly mint more millionaires than Silicon Valley ever will. The business owner millionaire often runs a company most people have never heard of and has no interest in being heard of. What separates them is cash flow. While investors wait for assets to appreciate, the business owner millionaire takes a check every month. That cash, reinvested consistently over years, builds wealth with a reliability that most investment strategies cannot match. The tech millionaire. The tech millionaire is the newest type on this list and the most visible. Early employees at companies like Google, Uber, and Airbnb became millionaires not through salary, but through stock options that vested over time. What makes this type unusual is that their wealth often arrived in a single event: an IPO, an acquisition, a liquidity round. One day they were earning a modest salary. The next, their shares were worth more than they had earned in their entire career combined. The challenge for the tech millionaire is that sudden wealth without financial education produces predictable outcomes. Studies of lottery winners and sudden wealth recipients show that without structured guidance, a significant portion of that money is gone within 5 years. The professional millionaire. Doctors, lawyers, investment bankers, surgeons. These are people who traded decades of education and grueling early careers for the ability to earn at a level most people will never reach. What makes the professional millionaire distinct is the starting line. Many entered their peak earning years with significant debt, sometimes $200,000 to $500,000 in student loans, and had to build wealth while servicing that liability. The ones who made it understood one thing early: a high income is not wealth. A high income spent at the same rate it arrives produces nothing. The professional millionaires who actually became millionaires lived below what their income permitted and invested the difference. The ones who did not are earning $400,000 a year and quietly struggling. The accidental millionaire. This type did not plan it. They bought a house in a city that became desirable. They held stock in a company they forgot about. They inherited land from a relative they barely knew. One day the numbers crossed a threshold they never deliberately aimed for. The accidental millionaire is more common than people assume. As property values in major cities have doubled, tripled, and quadrupled over the past 30 years, homeowners who simply stayed have become millionaires without changing a single financial behavior. The distinction that matters is this: accidental wealth and managed wealth are different things. Knowing a number on paper and knowing what to do with it are entirely separate skills. The frugal millionaire. This is the type most people live next to and never suspect. The frugal millionaire earns an average income, sometimes below average, and accumulated wealth entirely through the discipline of spending less than they earned for a very long time. Thomas Stanley documented this in exhaustive detail. His research across thousands of actual millionaires found that the most common profile was not a high earner. It was a consistent saver. Someone who drove a 10-year-old car not because they could not afford a new one, but because they understood what that difference in spending invested over 20 years would eventually become. The frugal millionaire is invisible by design. Their wealth is not a performance, it is a result. The paper millionaire. The paper millionaire has a net worth that crosses 7 figures, but very little of it is liquid. Their wealth exists in equity. In a private company, they cannot easily sell. In real estate, they have no plans to offload. In stock that has not vested. On paper, they are millionaires. In practice, they cannot easily access most of what they own. This type is more common than the number suggests. Many small business owners fall into this category. Their company is worth $2 million if sold tomorrow, but selling it tomorrow would mean ending the thing that generates their income. The wealth is real. The access to it is complicated. This is the least discussed type of millionaire. And it may be the most instructive, because it reveals something the number alone does not. $1 million is not a destination, it is a structure. And how that structure is built determines everything about what it actually means in a person's life.